just very quickly, good. We've got a good turnout tonight. This is wonderful. I'm going to hand over to Russell in a second just to say you're all very welcome to the Library of Mistakes. This is now the 4th event that we've put together for the Edinburgh Finance Festival. Our final one is tomorrow night. So I'm delighted that you could all come along. And then we do have an extra event next week that we're putting on next Tuesday. As Robbie kindly pointed out on LinkedIn, it is not the 31st of September, it's the 30th of September. We've got George Selgin coming to talk about the Great Depression, Franklin D. Roosevelt, and the New Deal. But as I say, all of these events, they're online, you can watch them on video. Do, if you can, if you see the QR code, please donate to the Library of Mistakes. And I'm now going to hand over to Russell.
Thank you, David. Welcome, everybody. And just a reminder, our course is coming up in London, the real one, the in-person one, 2.5 days. So if you have any friends, family, or relatives who would like to send on that, please do so. And you can find details on that on the website for the course, for the Library of Mistakes website. So tonight we are delighted that Mario Pisani has joined us from London, from HM Treasury. He's in the Financial Stability Group. Prior to that, he was in Debt and Reserves Management. And apart from that, he runs the History Network, which is a fascinating thing, trying to create an understanding within Treasury on the history of the organization, its policy, as well as how the organization is run, and create a longer institutional memory, so very much aligned with learning from financial history. And he's also a trustee of the Royal Mint Museum, which is in Wales, but has got on-loan articles all around the United Kingdom. So we have a practitioner from HM Treasury, steeped in financial history, who's going to talk about money and financial history, the Treasury-centric view. Mario, over to you.
Thank you, Russell. Hi, everyone. Can I just say what a great privilege it is to be able to come and speak here at the Library of Mistakes. We have so many objectives in common in the Treasury History Network and here in the library, trying to promote an understanding of economic and financial history. I'm trying to help, in my case, help the Treasury and colleagues, but in your case, helping everyone learn from the mistakes of the past. It's also a great pleasure to be able to speak in Edinburgh. Earlier in my career, I had an opportunity to spend quite a lot of time here when I worked for Alistair Darling and then during the referendum, and it's a city that I am very fond of. So this is a real privilege. Thank you. Now, tonight I wanted to offer a few observations about the links between money and institutions, because, I don't think we talk about money enough. We certainly don't talk about money enough in the economics profession. We often don't talk about money enough in the Treasury. But money is so important because it's such an enduring human-made social construct. And sterling itself, I think, is the longest continuously in use currency in the world. My proposition tonight is that the best monetary systems are those that are based on trust. And the best way to maintain trust in the currency is through the role that state institutions can play in safeguarding that trust. This means that money is a powerful symbol not only of the power of human endeavor, but also the public good that state institutions can bring. So a lot to cover there. And I want to start by showing you a picture of some money. This is a beautiful coin minted in 1937. It is a 5-sovereign piece, and it features King Edward VIII. So you might ask, what is the value of this coin? Its nominal face value is just £5 sterling. So you could take it and you could use it to exchange it for £5 worth of goods and services. But that wouldn't be very wise because it's made out of 22-carat gold, contains about 40 grams of gold, which at current market prices make it worth about £3,000. So is that the value of this coin? Maybe or maybe not. And that is because in 2021, a coin just like this one sold at auction for $2.3 million, making it the most valuable sterling coin ever sold. So is that the value of this coin? Well, as I'll explore tonight, it depends what we mean when we talk about the value of money. So I want to start by talking about the links between the economy, society, and money. For markets to function, we need a medium of exchange. Most of the time, that medium of exchange is money. But how do we know the value of money? Economists, and I'm one of them, let me be clear about that, we often describe money in terms of what it can do. It can act as a unit of account, a store of value, and a medium of exchange. And they're really great definitions, but they tell us what money can do, not what it is. At primary school, my children, they're learning about money by solving simple mathematical problems using pictures of coins. In fact, these are not the current standard issue of the coins, but anyway, never mind. Even when I did my undergraduate economics, there was still a tendency to think that money had developed as a commodity medium of exchange, which had come about as a way of avoiding the need to barter. I think now a lot of people call this the barter to money myth. And it's a myth because, as it has been well documented, before money existed as physical tokens, it existed as an intangible system of credit and clearing. There's evidence that monetary exchange has existed since the time of the Sumerian and Babylonian empires, which were able to transact not by exchanging bits of metal, but by issuing debts or promises to pay back later, and you could take on one of these promises in exchange for some goods. All the bilateral obligations were then recorded using a central system or were understood to exist between the members of a group. So intangible money has existed for a long time alongside physical money. The earliest examples of metal coins date from around the 7th century BC, when the Lydians in modern-day Turkey produced coins made of electrum, which is an alloy of gold and silver. And this payments technology, this monetary technology, sort of spread quite rapidly through the city-states of ancient Greece because it really helped urban populations engage in exchange and allowed them a mechanism to trade. In post-Roman Europe, there are comprehensive written records of market activity, and it's during the Middle Ages that other institutional and technological advances emerge, such as the introduction of credit and banking, which allowed credit to be created by adjusting entries in a ledger, and this in turn facilitated exchange and so on. So money has been physical and intangible for centuries. But even when you just look at the physical money, it hasn't always just been metal and paper. Because I'm a trustee at the Royal Mint Museum, whenever I go to a new city, I try to go to see their money collection or go to a money museum. There's loads out there. Someone earlier was telling me about seeing the collection in Lisbon, which I'm sure is great, and I'd love to go and see it. But you go to these museums, and they often will have, obviously, the national currency and their own coins and notes. But they go back in history and have all these examples of other forms of physical money from all over the world and over the centuries. And here's a few that I've seen over the years. You got the little clay tablets from Mesopotamia, the shells that were used across the African continent. There's a playing card there from Quebec in the 18th century, and the one that everyone talks about, and I see people nodding, the stones with a hole in the middle from the Pacific island of Yap. And what's interesting is that none of these forms of physical money have any intrinsic or commodity value. So they're all just tokens which represent economic value. And that's not always been the case, because even though today we're accustomed to the idea of fiat money, or money which has no intrinsic value, that's not always been the case. I mean, I suppose since the end of the Bretton Woods system in '71, that there's no formal link between the world's leading currencies and the dollar, and then between dollar and gold. So for many centuries, our view of money was based on the commodity value of the currency, precious metal coinage, gold and silver standards. For many centuries were the norm. But whatever its form, whether it's physical or intangible, money is always a liability, an obligation. In simple terms, money is like holding an IOU, which I as the holder believe will retain its value until I pass it on to someone else in the future. And that is why money, in my view, is better thought of as a social technology, which helps to coordinate activity and which allows us to understand, measure, and exchange economic value, rather than a commodity with inherent worth. Or to paraphrase John Stuart Mill, money is a machine, a social machine that allows us to do easily and quickly things that would otherwise be difficult and slow. So money is a social construct with these incredible useful properties. But to be able to perform that role, we often say that money requires users to trust it. The most successful forms of money are those that are underpinned by a widely held and workable, stable relationship of trust across society. There's an aphorism that says, you know, money works best when no one has to think very much about exactly how it works. And I think that aphorism often rings true because of this idea of trust. The best money is the trust that we all just trust inherently. And I like the idea of trust. I think it's great. But I think we can define it a bit more precisely by looking at some of the characteristics of successful forms of money. And at the core of that, I put two things in my perspective of money. One is the creditworthiness of the money. So I, as a user, need to know that the economic value that is represented by the money will be maintained over a reasonable period of time. And second, money needs to be transferable. So users need to know that the vast majority of people will accept it as payment in the future. But like layers of an onion, those two characteristics of money, creditworthiness and transferability, are in turn supported by other attributes that enhance the relationship of trust that makes money successful. One such attribute is security or surety, which supports creditworthiness. Anthony Hodson has written this really good book looking at the development of money in the UK. And one thing that he brings out is how most forms of money are backed by collateral. Or explained in other ways, I said earlier that money is a liability, an obligation. Generally, we try to hold an asset against an obligation or a liability. When money was made out of precious metal, the collateral, the asset, was the precious metal itself in the coin. So I knew that, you know, the token represents a pound, and I know it was worth a pound of precious metal. During the gold standard, issuers had to hold gold to the full value of the money in issue. Even these days, Bank of England banknotes are backed by financial assets. Because knowing that there's an asset providing security increases the creditworthiness of the money and in turn makes it more trusted among the users. Another important attribute is uniformity or fungibility. I don't know how much you guys read the speeches that the governor of the Bank of England gives, but he likes to talk about the singleness of money. And this is an idea that the most successful monetary systems are ones where users are indifferent between the various forms that money may take. This is the Bank of England's official definition on the slide. You know, interchangeable without loss of value in all forms. And you can see how that supports the principle of transferability of money. You know, if I am completely indifferent between cash and bank deposits, I don't mind receiving payment in either, because I can transform it from one form to the other very easily. So the four characteristics of money, which support trust, creditworthiness, transferability, security, and uniformity, one thing that I do when I think about them is that I don't think of them as black and white. I think they exist in a spectrum. Some very clever colleagues of mine talk about the moneyness of money. You know, you have money that is, or in other words, you have money that scores very highly against all these characteristics, and that makes it very good money. Or you can have money that doesn't do so well on some of these, and therefore is less good money. And, you know, I think it's fine to have deviation from perfection. It just means that some of that money, for a while, perhaps is not quite as good. In a way, some of the best ways to illustrate this is through historical examples. So I got a couple. One is from the 1500s, and one is from the last 15 years, starting with the older one, which is about English silver coinage in the 16th century. As mentioned earlier, when we had a precious metal standard, the security in the money was contained in the coin itself, so users knew that the economic value represented by the coin was backed by the value of the silver within it. But the problem was that In the 16th century, silver coins became worn over time, and the silver content reduced. Also, it was before the introduction of mechanized coinage, so these coins were very susceptible to clipping and counterfeiting. But worst of all, there were some deliberate debasements of the currency under Henry VIII. So I think sterling takes its name from the very high silver content of the coinage, 92.5% silver, I think, for over 300 years. But after Henry VIII's various debasements in the 1540s, some of the silver coin issued had a silver content as low as 16%. So all of this, you can see, damaged the security provided by the coin, which affected its creditworthiness and made it not very good money. These two examples are from the Tudor period, one with high silver content, one with lower. And in fact, a lot of the lower quality coins traded at a discount because people did not think they had the same value as the other ones. Later on in the 17th and 18th century, when copper was being used for coins more widely, the desire to match the face value and the metal value of the coins resulted in some very interesting coins. This is a 1797 cartwheel 2p coin. I actually got my own version of it, which I'm going to pass around the room. But it'd be good to get it back. There you go, Russell. Thanks. And then, because it's going to take a while for it to come, I've also got a set of the current latest issue, 8 denominations of sterling coinage with King Charles on them. That is just for fun. Now, this coin is remarkable because it contains 2 full ounces of pure copper, 57 grams of pure copper. You'll see in a minute. Pick it up, play with it. It's quite heavy. And it was developed because of the shortage of silver coinage at the time, and also because of the expansion in the economy and the need to grow the stock of low denomination coins. Just for comparison, I got the current 2p coin there as well, which weighs only 7 grams and only contains 3% copper. And comparing the two coins, I think it really illustrates some of the constraints created by having a metallic standard as opposed to a fiat currency. So while that goes round, I can talk about the other example, which is Bitcoin, which has been around since 2009. Is it money? I suppose the volatility in the value of Bitcoin means that as a user, I cannot really be sure that it'll be worth the same tomorrow or that it'll be worth anything. There's no security behind it, so I have even more doubts about its creditworthiness. And this is why I suppose many people would not accept it as a form of payment. I cannot be sure that I'll be able to transfer it to someone else in exchange for goods or services. You might not agree. It'd be good to discuss it later. And by the way, I'm very keen for people to disagree with my thesis tonight, or to agree with it too. On to the second part, which is where I'm going to say something about the links between money, institutions, and the state. And I'm going to focus on the arrangements in the UK, and I'm going to talk about 4 institutions. I'm going to talk about the Royal Mint, the Treasury, the Exchequer, and the Bank of England. I'm going to start with the Royal Mint. And that coins are the oldest form of physical money in England, dating back to at least pre-Roman times. And as an aside, it was, as you know, it was the Romans who came up with the idea of Britannia, a representation of their territories in the British Isles. And she first appeared in Roman coins, such as this one from the 2nd century AD. And she still appears in some of the circulating 50p coins that you can get in your change. She's also in all the Bank of England banknotes. And then the 4th one I have there is Charles II period, I think, 1670s coin as well. She looks quite different in all these representations, and that's quite a big topic and one that is not uncontroversial. After the Romans, systematic production of coinage started across England, and it happened at various local mints. There were something like 70 different local mints, which by royal decree had to be near towns so that they could produce coinage to facilitate exchange in marketplaces. And the mint itself puts its origins around the time of the large issue of silver pennies under Alfred the Great in the late 9th century. There's a picture of it, of one of them. And that developed through the 10th century and beyond. And since then, and up to the present day, the Royal Mint has produced sterling coins for the Crown. These days, the Royal Mint produces coinage on behalf of HM Treasury. But one thing that's interesting is that the Royal Mint has not always had the monopoly on the production of coinage. In fact, if you look at that copper cartwheel two-piece coin, you'll see that under Britannia's shield, there's the mark of the Soho Mint, which is the coin production operation set up by Matthew Bolton in Birmingham, which got a contract from the Treasury to produce coinage in the 18th century. In accounting terms, coins, unlike banknotes, do not take the form of an explicit obligation, and that's because there's no promise on the coin to pay the bearer the face value of the coin like there is on banknotes. However, in substance, the issuer, i.e. the government, has an obligation to redeem on requests all coins that are in issue at face value. In fact, you could take that very old coin to a bank now and they'll credit your account with 2 pence if you wanted to do that. And that means that if we link back to the discussion earlier about security, the sterling coinage in the UK now is the one form of money that is not backed by any assets, even though the government does recognise a contingent liability for it. And one of the reasons it doesn't really need to be backed by assets is because as a percentage of the total money stock is quite a low number, as we'll see in a minute. Today, the Royal Mint is owned by HM Treasury, which is as you know, the UK Finance and Economics Ministry. The Treasury is not quite as old as the Royal Mint. The role of the Treasurer, or the person charged with safeguarding the King's treasure, goes back to only the 11th century, where in the Domesday Book of 1086, there's a reference to Henry the Treasurer. And over time, that role evolved into that of the Lord High Treasurer, who oversaw the work of the Treasury and the Exchequer. The Exchequer then in turn is also slightly less old, dating from the 12th century, and eventually it became subsumed within the modern Treasury. The ancient Exchequer was divided into 2 parts, the lower Exchequer and the upper Exchequer. The lower Exchequer was just the money in and money out bit, so they collected funds from taxation, they gave them out for expenditure. The upper Exchequer is the bit that conducted the twice-a-year audits on the money that was coming in and going out, using the checker cloth, which gave it its name as a little accounting device. The lower Exchequer today is effectively the central funds and accounts of the government, which are run by a team at the Treasury. And the upper Exchequer is today effectively the National Audit Office, which was, that happened in 1866 through an Act of Parliament. Now, one of the most important periods in the institutional history of the Treasury is the second half of the 17th century, following the restoration of Charles II, because in the decades that followed, a lot of big changes came about. For a start, the Treasury stopped relying always on just the Lord High Treasurer and was run by a commission. Not all the time, but most of the time. It's been run by a commission continuously since 1714. And that commission was, for the first time, made up by people who had some experience in financial matters. It also is a time when the Treasury and the Exchequer physically separate. They used to be located together in the Palace of Westminster. In the 1660s, the Treasury moves to Whitehall Palace, which is not too far off where it is today. The Treasury also acquires a lot of new powers in this period about new controls over expenditure and powers to oversee the collection of taxes and manage the government's revenue. It is also around this time, in 1662, that the Mint introduces mechanized coin production systematically. And that increased capacity and efficiency, also allowed for the use of milled edges, which was an important innovation to prevent clipping and counterfeiting. It's also around this time that the Act for the Encouragement of the Coinage of 1666 came in, which meant that if customers wanted to convert bullion into coin, the Treasury will cover the costs of doing that rather than you as a user having to pay for that. And all these financial innovations took place despite the recurring wars that England was engaging in at the time. I think 8 wars over a 30-year period, most of which didn't go very well for the English and were also very costly. And, you know, this almost constant state of war put a lot of financial pressure on the national finances. And by 1697 and the end of the 9-Year War, the national debt stood at £14.5 million, which these days sounds like nothing, but it was a lot back then. The combination of that and the stop of the Exchequer in 1672, where the king effectively defaulted on his debts, and later the impact of the Glorious Revolution meant that the balance of financial power shifted away from the monarch and towards Parliament. And it's in that context that the famous recoinage debate of 1696 takes place. And that came about because for over 30 years, the hammered coinage made by hand was circulating together with the milled coin that we have here. And what happened is that all the good silver coin was going abroad, where you could sell the silver and get a much higher value than the face value, and all the worn, underweight, counterfeit coins stayed in England. So there was a big debate about what to do about it, and there were 2 people on each side of that. On one side was William Lowndes, who was the secretary to the Treasury, and he was in favour of having a flexible monetary standard where the silver content of the coin could be reduced to match the face value. On the other side was John Locke, so the Enlightenment philosopher, huge intellectual father of the new political settlement, who believed in a commodity theory of money and basically thought that the crown should not interfere with the universal value of the silver in the coinage. The debate ended up with victory for Locke and the survival of the silver standard, which was then implemented through the recoinage of 1696. But today, even though Lowndes' vision for the monetary standard did not survive, most historians think that Lowndes was correct and actually way ahead of his time in the way that it was thinking about money. And that's interesting because today, and this is just a little anecdote, his portrait, the 2 of his portraits are in London. His portrait adorns number 11 Downing Street, which is, as you know, the residence of the Chancellor of the Exchequer. But even more importantly, another portrait of him hangs in the room at the Bank of England, where the Monetary Policy Committee decides on interest rates. And as Dave Ramsden, the Deputy Governor, pointed out to me, he's wearing very interesting shoes as well. Now, out of the political settlement of the 1690s also emerges the Bank of England. And at the time, the government needed funds to finance the war against France. So the bank agreed to give the government a permanent loan of 1.2 billion sterling at a rate of 8% interest, which is a lot better than 14% interest that the government was paying at the time to borrow. And in return, the government gave the bank 2 things: the right to set up as a joint stock limited liability company and non-monopoly rights to issue paper banknotes as legal tender. And this is a really important moment because it's a coming together of privately issued money by the bank, but with the endorsement of the Crown, which therefore made it as trusted as coins bearing the effigy of the king. And it meant, really was the beginning of a long-lasting relationship between the government and the bank, which is still strong today. But the truth is that banknotes had emerged sometime before the Bank of England. Earlier in the 17th century, banknotes were used quite actively because of the activities of 2 professional groups, the scriveners and the goldsmiths. And what they would do is that they would issue you a bill or a receipt or a note for credit or as proof of a coin deposit with them or a bullion deposit with them, or they would do it with tally sticks, but we can come back to that. And that was happening as early as the 1610s. There's a nice story in Nicholas Mayhew's History of Sterling, which is taken from Samuel Pepys's diaries, about how in 1668 he sent a note. So this is 30 years before the creation of the Bank of England, a note to his father. And he says it was described with a casual passing reference to the note, to the banknote, which suggests that by this time there was nothing remarkable about banknotes like this, which I think is really interesting. Now, the bank has been issuing banknotes since it was founded. And then over the course of the 18th and 19th century, Bank of England notes became the preferred way of settling large transactions. And then in time, the transactions evolved to clearing banks that were participants with the Bank of England. They also started to use a thing called bankers' balances. So rather than, move the notes from one bank to the other, you just adjust the ledger so that one bank has fewer assets and the other one has more assets. And that is basically a version of what we now call central bank reserves, and I'll come back to that. So having looked at the four institutions, we can now look at the main components of publicly and privately issued money in the UK today. So I've got a chart now. These are all for the same year, I think it's 2022. There's about £5 billion worth of coins produced by the Royal Mint in issue. That's the small navy blue area down there. There are £82 billion worth of Bank of England banknotes in circulation. I've been wanting to do this. Other places I need to say as a small aside, but here I say as a very relevant aside, it's worth pointing out that there are also 6 private banks that issue banknotes in Scotland and Northern Ireland. And they're worth about £4.5 billion. And they look completely different, as you will know, from Bank of England banknotes. I've got one here. This is one of the Northern Irish ones, which I think is particularly interesting because it's got portrait, not landscape orientation. Most banknotes are landscape orientation. I actually got the £5 version of this in my wallet. I don't want to spend it. In fact, it's quite hard to spend it in London. But now, the issue of these banknotes by the 6 private banks is fully backed by holdings of Bank of England banknotes to the same value as the backing asset. Then there's the wholesale deposits that commercial banks hold at the Bank of England. So these are the central bank reserves that I mentioned earlier. And that is another form of public money, which is used for electronic transactions between the commercial banks. That's worth about £760 billion, the yellow area. And together, those 3, the coins, the banknotes, and the reserves, make up what we call public money. But, the majority of money is not public. It has been issued by private sector institutions, so the big light blue area here. And that is because the largest form of money by far are the deposits that households and businesses hold at commercial banks, and that amounts to 2,200 billion, 2.2 trillion. So the question immediately might come to mind, how can this type of private money, which is by far the largest, be linked to the state? And the answer to that is down to state institutions to safeguard the banking system that issues so much of that money. And that happens in a number of ways. For a start, all deposit-taking institutions in the UK need to be authorised and regulated by the Bank of England. They are made to hold high-quality capital to absorb losses in a range of stress scenarios. They also have access to the Bank of England as the lender of last resort for liquidity at good times and bad. Also, our deposits are protected up to £85,000, and the Financial Services Compensation Scheme, which is the body that manages that deposit guarantee scheme, is funded by industry but is underpinned by access to government funds. And if all of that fails, ultimately the Treasury has its financial power that can be deployed as a last resort in a crisis, just as we saw in 2007 and 2008. And that is why, looking at money today, it is always possible to trace a line back to the state. And in that complex organizational institutional web, I suppose one of the most novel things that I'll say today is that at the core of all of that is the Treasury. We generally think of the Bank of England when we think about money, don't we? Or the Mint. But I'm saying really at the heart of it all is the Treasury. And that is because the Treasury is the sole shareholder of the Bank of England and the Royal Mint. Treasury ministers appoint the governors of the Bank of England. They appoint the chief executive of the Royal Mint, as well as members of the boards of both institutions. And the Treasury can use our legislative powers to set new objectives for both. And in that institutional puzzle, the Treasury emerges as a central but unexpected player when it comes to instilling trust in the monetary system. I suppose my logic goes that because money requires faith in its financial backing, and because the Treasury has the most powerful financial backstop available through its tax-raising powers, it stands to reason that the Treasury should be able to be there at the centre of this network. and use its legislative powers to increase revenue when needed by raising taxes, and at times of crisis, if needed, using that revenue to protect the value of our money. Another way to think about this is to go back to what I said earlier and think of money as a liability or an IOU. And the ability to issue liabilities depends on a range of factors, but I suppose in a nutshell, it's probably down to creditors' perceptions of potential risk and return. So one thing I've done here is that I've looked at the balance sheets of the four institutions that I've talked about and the government, but rather than presenting it as present the assets or the net asset position, I presented the liabilities and the net liability position. And if you look at the institutions that I've talked about, you can see the extent to which they're able to issue liabilities. So while the Bank of England has just about over 1 trillion liabilities in issue, although that's a bit lower now that they've been doing QT, the Treasury and the Exchequer together have something like 2.5 trillion liabilities in issue, while the wider government has over 6 trillion liabilities in issue. And that's because it is governments, thanks to the tax-raising powers of the finance ministries, who are best able to do that. Having said that, however, the ability to issue liabilities depends on a number of other conditions, and maybe this is something that we'll get into in the discussion. For example, I'm not going to buy the liability of a government if I don't believe in their ability to control inflation. I need to make sure that the real value of the liabilities will stay stable over time. I also need to believe that the society will continue to support the political process that gives the government and the finance ministries those powers. And sometimes these various objectives can be in trade-off. And that is why public institutions need to be there to help navigate those trade-offs. I think it was the financial economist Simon Minsky, who must be a popular person in this library, who said, I think he said, any idiot can issue money. I changed it to anyone can issue money. The problem is to get someone else to accept it. And I think that's really true. Trust in money comes from its creditworthiness and its transferability. My contention is that these qualities are strongest thanks to the historical links to the institutions of the state. So how does this link to the Edward VIII coin that I showed you earlier? Well, the discrepancy between the face value, £5, and the bullion value, £3,000, shows the folly of the conventional view of money as a commodity. The silver and then gold standards persisted because the state regularly revalued the currency to reflect economic, demographic, or other changes. As I've explained in this talk, for money to be able to facilitate exchange best, the monetary standard needs to be flexible and able to adapt to without the constraints created by the precious metal. But this coin also shows the importance of respecting institutions. Because one of the reasons the coin has such high value to collectors, at $2.3 million, is because Edward VIII broke with the tradition, which goes back to Charles II, that each new monarch's effigy should face in the opposite direction of their predecessor. And that makes this coin extremely rare and very valuable, but not very good money. I'll stop there. Thanks.
Thank you, Mara. Can we go back to the one on just the breakdown of money, bank money, and just so that everybody gets it? So, because there was a kind of throwaway line in there, which is really interesting, that the only form of money that isn't backed is this one down here, which is the coins. Yeah. So why don't you run us through the backing of the others? Because we often hear our money isn't backed. Yeah. But actually, 1, 2, and 3, there are assets on the other side of that. So why don't you run through what those assets are, and then we'll talk about how the Treasury or the Bank of England is involved in this process. So.
Great question, Russell. First of all, a caveat that if you saw this in a paper, there'll be a footnote that says this is a bit different to the way we might think about a monetary aggregate. So, this is done for simplicity because two of these categories slightly overlap, as I'll explain in a minute. So the banknotes are the easiest in the sense that they're the liabilities of the Bank of England. So, and it says right on there, I promise to pay the bearer whatever. And they are backed by the assets on the other side of the balance sheet, which at the moment is mostly government bonds. But not only, it can also be other financial instruments like repos. The bank has a net asset position, so they have capital, provided by the Treasury, but anyway, we'll get onto that. So, they have more assets than liabilities. So that's the backing. So, imagine that tomorrow everyone decides that they don't want banknotes, they want money in their accounts, they want the blue stuff. And you'll take it back. Over time, the liability side of the Bank of England balance sheet will get smaller, and so would the asset side. For the central bank reserves, from the perspective of the Bank of England, there are also liabilities, in the sense that they're the deposits that the commercial banks are holding at the Bank of England. And again, they're backed by holdings of government bonds mostly, but also repos. The commercial bank money, again, is backed by the asset side of the commercial bank's balance sheets. And it's not clear that they do one-for-one backing. They obviously need to be in a net asset position, i.e. they need to have capital, or you're in a 2007 solvency crisis situation like we had with Northern Rock and then other banks. Does that answer it?
Yeah, so you've covered it, but we'll just cover it again. So the assets of these banks tend to be relatively illiquid, but depositors can demand the money back. So we'll just explain how the Bank of England can help with this when there's a need for deposits, and what the Bank of England can do while the money's still backed. And then we'll probably get to that announcement at the back when the Treasury has to get involved. But there's an intermediate step here for money, in which if the commercial banks can't realise their assets in time, the Bank of England helps.
Yeah. So I'm very happy to do this. There's probably someone in the room who knows more about it than me. But the simplified commercial bank balance sheet has the deposits as the liabilities. And then on the asset side, it has loans and securities. The high quality, very liquid asset there are the securities, government bonds. You can sell them into the market and make them into liquidity quickly. The less liquid asset class are the loans. You can't sell them quickly. In a liquidity crisis, a temporary mismatch between assets and liabilities, if it truly is just a liquidity crisis, i.e. more people are turning up saying, give me my money in cash or let me move it to another bank. In theory, through the standing facilities of the Bank of England, all these commercial banks can get unlimited sterling borrowing. So they can always borrow from the central bank. This is the lender of last resort function, Walter Bagehot, very important. And to be a deposit-taking bank in the UK of any size, you need to be familiar with these facilities. There are weekly operations. There are operations that take standard collateral. There are operations where you can offer less good collateral. You need to test it regularly. So it's a very important part of the architecture, and it's there so that faced with a liquidity stress, the central bank can always supply sterling at will, unlimitedly.
Now let's go to the thing we have on the back wall, which I picked up the day after that announcement. So Britain's 500 billion bank bailout special is the Treasury. That was picked up on the corner of Moorgate and London Wall. So a whole generation never had to live through that. So now the Bank of England isn't enough. When do we go to the Treasury? Because this liquidity operation isn't sufficient to back the money, if you like, to make sure there's a transference, liquidation of assets in return for the liabilities we call money or deposits. What is it that gets the Treasury involved?
So, liquidity provision is clearly the domain of the central bank and the Bank of England, and they can just do that to any degree they need to. One thing that is tricky is, you don't always know in real time how much of the crisis is liquidity and how much is solvency. I mean, that happened before the introduction of the Banking Act 2009, and now there's some other things that we have in terms of resolution plans for all major banks. But in any case, whether it's before that or now, sometimes there's just not enough on the asset side of the balance sheet to meet all the obligations. That often happens because you suddenly discover that these illiquid assets are not worth what you thought they were worth. So the loans are not going to be worth what they're worth. And that means that this is why banks have to have capital. You need to have assets in excess of the liabilities, but sometimes you could exhaust all the capital. The 14% I think it is now was less back then. And it means that someone else needs to come to make good the losses. Even in the current setup, we call it temporary public ownership. It's still there, still a resolution tool that you can use as a last resort. But the idea is that, before you get to that, the banks need to exhaust all their capital. They also need to hold now convertible capital instruments that can be used to make good losses, and so on and so forth. But ultimately, if things are bad enough, the finance ministry needs to get in. There's a saying that goes, when banks get a cold, they go and talk to the supervisors. When they're doing really badly and they're very ill, they go to the central bank, but it's only in death that they go to the finance ministry.
Well, we have a famous episode here in Edinburgh of that, where one of those banks turned up with a panettone to see Alistair Darling as a present. Fred Goodwin apparently turned up with a cake, and when he was asking for that intervention. Anyway, so I think hopefully we've explained, or you've explained, how all of this fits together, then the role that Treasury plays in certain situations, Bank of England in the other. Everybody, I hope you can join us for drinks afterwards, provided by Kennox Asset Management. Please take your glasses to the back. But before you do that, please join me in thanking Mario Pisani. Mario, you want to turn this off?